We're rolling.
Welcome to the House Dudes podcast, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Jack Haas.
And I'm Josh Koth. Here at House Dudes, we believe in a couple key principles. Number one, the best way to retain information is by teaching it to others. And number two, a rising tide lifts all boats. We're not competitors, we're a community. So let's get into some real estate investing.
Hello, everyone, and thanks for joining the House Dudes podcast. Today's guest is Jim Oliver, the founder of the wealth coaching company CreateTailwind. Jim founded CreateTailwind in 1988 in Denver, Colorado as a traditional financial planning firm, but after weathering two major corrections on Wall Street, Jim and his team pivoted the company's focus to building wealth beyond Wall Street. With this advantage, CreateTailwind exploded to become a multi-location, nationally recognized firm that has helped thousands of individuals and businesses around the United States create their own wealth and be their own bank.
To a great mentor, R. Nelson Nash, and I followed him around the country for a couple of years, learning more and more from him. He just passed away last March at 88. But what I learned is that I can invest more in real estate and I can make more money in real estate and buying businesses by controlling the banking function as well. And so people have heard this probably as bank on yourself or infinite banking concept or becoming your own banker. And a lot of those things are talking about how to get out of debt doing that, how to buy your cars, pay your taxes, all that stuff, maybe save for college. And those are all great, but we're really taking it at a different approach where we're talking about how to build your wealth by controlling the banking function and therefore investing other people's money in real estate, et cetera, and leveraging.
Sure. We've had that buzzword come up we host a local real estate meetup, and we've had that buzzword come up quite a bit, the whole infinite banking and being your own banker. Can you go into detail a little bit about what you mean by that, being your own banker?
Sure. So what I mean is you building your own money pool that you can collateralize, guaranteed, and you can collateralize it at 100%. And what I mean by that is if you had $1 million in your banking system, then another entity, another financial institution has to give you $1 million of their money, and they put a lien on your $100 or your $1 million while it's in a tax shelter growing uninterrupted. Okay, so compounding uninterrupted. So now, if you think about it, you have your money in a safe environment growing. Now you have another entity's money that you're putting in motion to go buy assets, not instruments, right? Assets like real estate. When that real estate cash flows, if you cash flow it back to your checking account at a commercial bank, you're doing it wrong. Flow it back into the bank you can control, right? And then as you build up money from that cash flow, what do? You do it again, and you do it again, and you do it again. And, I like to think that you have to understand the very basic transaction in a bank. A bank has a depositor that comes down and deposits money at their bank, right? And by the way, when they do that, it's a liability to the bank. They have to do something with that money immediately because it's, they have to pay for the bank, they have to pay for the employees, everything else. Now, we're trained to think of a deposit as an asset, but it's a liability to the bank. But how do they make it an asset? They loan that money out. So they loan that money at a much higher interest than what they're going to pay us, and they can make over 2,000% profit margin doing that, okay? But there's three players in the play, and Shakespeare said, if you understand the players in the play, you'll know what's going on. So you have the depositor, the owner of the bank, and the depositor. And infinite banking in a nutshell is just making you all three of those players. And if you're all three of those, Jack, how do you lose money?
Right.
And how does money leak out of your system? It can't. Does that make sense?
Yeah, it does. Like I had mentioned, we kind of hear this terminology and this concept thrown around quite a bit lately over the last couple of years, I would even say. When people are interested in this type of thing, and they're talking to an advisor or specialist associated with this, what kind of questions should they ask? Because I see, like, let's say Jim Oliver is the one I choose. You become like one of my team members. I mean, it's one of the, I mean, it's a strategy session and setting all this up. What questions should a person ask when vetting out or making sure this is the proper fit for them? Because I'm always a little concerned that some people throwing that term around, I don't want to call it snake oil, but there is some misconceptions or some things could be set up incorrectly or what have you.
Yeah, so that's a great question, by the way. I think the biggest thing is, how long have you been doing infinite banking yourself? To
Mm-hmm.
what level are you doing it? Tell me some of the loans that you've done. Tell me some of the real estate projects. If you're a real estate investor, then that practitioner, that infinite banking practitioner, should be a real estate investor as well.
Mm-hmm.
Tell me how you've bought real estate using this. Tell me how you've bought businesses using this. And tell me exactly, so there are marketers out there on YouTube and Facebook that are focusing on the insurance policy.
Mm-hmm.
Okay, that's the money pool. Okay, but this
Right.
is a process. It's not about a product. You could do infinite banking and put your money in a can in your backyard. Okay, but it's not as efficient as using the right kind of insurance contract. But it's not about the insurance contract. It's about your behavior, and it's
Sure.
about your thinking. And, it's funny because Thomas Edison said 5% of the people think, 10% think they think, and the other 85% would rather die than think.
Mm-hmm.
If you can't be open-minded to understanding how the banking function affects you in your life and the problems that it creates, unless you control it, then so really quiz them. Tell me about your portfolio. Tell me about how many loans you have out. How many policies do you have? Ask them anything. And if they
Mm-hmm.
can't answer those questions directly and confidently and even show you some of the things they've bought, then that's probably not the right person. There's a lot of great people out there that do this, and you just have to find people that are really walking the walk.
Sure. No, that's a great response. A great way to see it too. So, I'm always interested in this aspect because you mentioned that you were a traditional financial advisor before this.
Yep.
And I've always found that especially that, or there is, the best way to describe it is an indoctrination. The belief system associated with traditional investing. And you'd have to have that belief system to the point of, you're comfortable and you're excited to sell it. What was that process for you like when you changed your mindset and switched over to real estate investing? You noticed these people in your life that were becoming successful in their investment. There had to have been a pretty significant mindset shift there.
Yeah, there was. And, the way that I got into financial planning is I grew up very poor in the inner city part of Los Angeles. And in Los Angeles, everything is very close. So I grew up in Inglewood, California, but 3 or 4 miles away, there are multi-million-dollar houses even back then in the 60s and 70s. And there's Manhattan Beach, and there's Beverly Hills, and there's Palos Verdes, and you're thinking to yourself, what do these people know about money that I don't, or that my family doesn't, right? And so I studied money, and it seemed like all of the traditional books and articles and magazines said the stock market, the stock market, the stock market. So that's what I got involved in. But what I would see is that there's a huge disconnect between actual rate of return and average rate of return.
Mm-hmm.
And when you get reports from your traditional financial planner or mutual fund or even your 401k, it tells you what you averaged, right? You've averaged this since you opened this account. This fund has averaged this since the inception of the fund. But average has nothing to do with actual rate of return. All of our platforms told us we had about $700 million under management, and all of our uh, platforms told us our clients were making a little bit over 9% average.
Mm-hmm.
Actual rate of return after tax, net was a little bit over 4%. Now, our clients think they're doing great. And if you ever felt like this, if you have a 401k, it seems like this thing's only growing by the amount of money that I'm putting into it.
Mm-hmm.
I've heard so many people say that over the years. So after a couple of corrections, we started to do that math, and we started to say, wait a minute. People that own businesses, people that own plastic companies, people that own welding companies and real estate companies, and these people that are business owners and entrepreneurs, they're making money outside of Wall Street, really much more significant than the money that we're making for them inside of Wall Street. So it was that paradigm shift that I said, we got to change. We got to be the opposite of a financial planning firm. We got to be the wealth creation firm. But there's a catch, because when you hire somebody to manage your money in a traditional financial planning firm, you hand them a check. Now it's all up to them. You don't have to do anything. But in real estate, you have to participate. It's a participatory sport. You got to educate yourself. You got to go to real estate meetups. You got to listen to podcasts like yours. You got to study. You got to educate yourself. You got to take control. And that's how you break out of the herd, right? But a lot of people don't want to do that. Sorry, that was a long answer to a short question.
No, that's exactly what I was looking for. One of those things, and I'm going to circle back a little bit on one thing, is that I always think, and then part of what we talk about and what we do here is try to give like real world examples, because I think that's really a great way for people to follow what we're talking about here. Could you take a moment and talk about like a recent transaction, or how you help set somebody up to acquire their first property or what have you, so they can see how this works? And
Yep. So I'll give you one that one of our young clients, this guy was a painting contractor, and he started to build his infinite banking system, his pool of money, and he wanted to become a real estate investor. And he was in Iowa. And I said, look for people, maybe people that are in their 60s and 70s that have real estate portfolios that want to sell them and that they're looking for cash flow. So he found a woman that needed some painting done, and he just asked her if she was interested in selling her portfolio. She said she was, and that it was worth about $2 million. Well, after he did some research, he offered her like $1.1 million. They settled on $1.4 million. So then she wanted 20% down. So he borrowed the money out of his insurance contract, and then he used the cash flow from these properties to pay back the insurance contract, and then she gave him a fixed rate loan for 20 years. So he didn't really work. That was just paid out of the monthly costs. Excuse me. He took another loan from his insurance contracts to renovate a few of the properties, which increased the rents, which increased the cash flow. And as that cash flow started to come back in, now he was still making enough money as a painting contractor that he didn't need the cash flow from this real estate portfolio. So it filled up his policies very quickly. So he borrowed the money again and went and bought a commercial building. So that's one as an example.
Sure.
Just where he built up his system. Now, by the way, you can get access to the money right away. Like if you put in a big lump sum, you can get access to it right away. But in his case, he built it over a year or two before he started getting into real estate. He needed to study the real estate side before he was comfortable pulling the trigger there.
So, and that's probably going to be pretty common. Do you have a lot of people who start this with a large lump like that?
It's funny. I have people that are putting, a few $1,000s a year in their infinite banking system, and I have people that are putting a few $1 million a year in their banking system. It just depends on everybody. That's why I like the infinite banking concept part of that, is because it's infinite. Everybody should take over the banking function in their lives, regardless of where you are economically. And it works for everybody. It doesn't matter if you're young or old or whatever your background is. It works for everybody.
So is this money that you pool there, can you lend it to other people?
Absolutely. One of the things that I do is I lend it to my companies. And when we have purchase order loans, or we have just normal like pay, I've loaned it for payroll. I've loaned it for projects. I've loaned it for expansion, inventory, and I charge anywhere between 10 and 30% to my companies when I loan the money out. And when you do that, because that when you just say that, Jack, it scares some people, right? But just think of it again. You got to think like a banker. So if I said to you, I've got this building over here that's worth $1 million, and I'd like to put it up for collateral because I need $300,000 of cash, and I don't have time to go to the bank or anything else, and I'm willing to pay you 12% interest, and I'll put up 50% of that building, and here's how it's cash flowing, and I'll show you all the numbers. You're actually, when you give me the loan, you're hoping that I default, because that's a really good asset to own, right?
Right. Yeah, no, that's interesting, because there's a lot of other self-directed IRAs and a few other avenues that people go down, but there's a lot of restrictions associated with how you handle and lend that money out. It doesn't sound like there is as many restrictions. Am I understanding that with this?
You are right on. Yeah, absolutely. There are not as many restrictions. And you got to remember, this stuff has been around for 200 years in the United States, over 200 years in the United States, 300 years in Europe. So way before the federal income tax came into play in 1913. And, the problem with self-directed IRAs or qualified plans of any kind is the restrictions, and it's a government program, right? The government can change the rules anytime they want. And here's an example of that. The Secure Act, which just passed, it changed how IRAs are passed down to the next generation. And it limited how you could stretch that out in those heirs' lifetime. So now it's much more restrictive when you're passing down an IRA. And now a lot of people have spent 20 years or more doing estate planning and planning to pass that IRA down. Now that's blown up. And the government could come in. I mean, 401ks and IRAs have only been around since 1974, and 401ks have been around since 1980. So these are not things that have, really been around forever. The government is still in control of that.
Well, since you opened that box, so how does this work then? Like, understand that this is basically the vehicle is a whole life insurance policy, right? And And if you listen to some big name people, I'll even throw the names out: Dave Ramsey, Susie Orman, all of those. They'll tell you to avoid whole life, but when you think about it, seeing it as a pass-through system, how does that's just kind of really changes the mindset associated with what that piece is. And I like that you mentioned you got to stop thinking of it as an insurance policy, but thinking of it as an investment vehicle. How does that get passed down to my kids?
So let's say that the insurance contract is on your life, right? And by the way, let me back up just a second, because those financial entertainers like Dave Ramsey and Susie Orman, and by the way, that's what they are, is they're entertainers. They're not really trying to educate you. They're trying to entertain you. And they do a great job of doing that. And there's a lot of things that they do for people, helping people with budgets and don't spend more than you bring in and things like that are good concepts. But there aren't 12% mutual funds out there over time, like Dave likes to say. And he falls into that traditional financial planning mentality, which if you told him you had a great real estate investment opportunity, he'd tell you, don't do that. Real estate's dangerous and you got to fix toilets and pay. And we all know that's just not true, right?
Mhm.
And that real estate has done much better than the stock market over time. But back to your question is the when you design the insurance contract, you can design it for death benefit or you can design it for cash. If you design it for cash, you will generate a much lower commission to the insurance agent.
Mhm.
So one of the reasons that insurance agents don't design insurance contracts to be the most effective and efficient for infinite banking is because it reduces their commissions by more than half, sometimes
Mhm.
much more than half. But our business model is very simple. Everybody that's ever started with us always grows their system, right? So our clients are constantly growing and buying more and more policies to shove money into. And once you start to take this money out, it's tax free.
Mhm.
So you think of kind of like a Roth, right, without the restrictions. Some people say like a Roth on steroids. I mean, I'm 54, so I went through the 80s where everybody was on steroids. So I don't like, I mean, everybody like in college football and, and Brian Bosworth and stuff like that. But if you think about, do I want to pay tax on the money going in or the money coming out? I want to pay tax on the money going in because taxes are on sale. The top bracket is 37%, right?
Mhm.
And if you're a real estate investor, you have this little secret superpower called depreciation,
Mhm.
right? That thank goodness, nobody in the general public really understands because it's a way to have a great tax situation, even if we're making a lot of money.
Mhm.
But I want to pay taxes now because I know what the tax rate is now. What is the tax rate going to be in 20, 30, 40 years when I take this money out? I have no idea. Is it going to be higher or lower? Well, I could make the argument that it's going to be higher, that it has to go up because of Social Security, Medicare, Medicaid, and the interest on the debt.
Mhm.
It has to go up. So I want to get my tax out of the way now. And then I want all that money tax-free when I take it out. Now, I don't
Sure.
say take it out for retirement because the definition of retirement is to be taken out of service.
Mhm.
And I think your listeners, if I'm one of your listeners in my 20s, I don't want to think about retiring at 65. I want to be financially independent by the time I'm 40 or 35.
Mhm.
And I've seen plenty of people do it. It's doable.
Sure. Yeah, um, I usually keep these to about the 30-minute mark, and I think we've kind of hit that. But I always end with this last question. Is there a question I didn't ask that you wish I would have?
A question that you didn't ask that I wish you would have is, gosh, I can't think of any questions that you didn't ask, but I'll throw one out to the audience if that's okay.
Yeah, you bet.
Or I'm going to give you a fact that you're going to find hard to believe. The average American pays 34.5 cents of every dollar they make in interest, not interest rate, but volume of interest.
Hmm.
Because of their mortgages and things like that, where in the first 5 years, 80% or more is going to the bank's benefit, and 10 or 15 or 20 is going to their benefit. So let me ask the audience a question. If you earn $1, and then like in a mortgage, over 30 years, half that dollar is going to the bank's benefit for
Mhm.
30 years, and half of it's going to your benefit. So you earn $1 and you got to give me half. Do you care what your interest rate is? I hope you answered no, because I'm just taking half your money.
Mhm.
If you want to learn to avoid that, learn about infinite banking.
Well, I can't imagine a better way to end this. And it's obvious that you have a lot to share. So where do people find you? I understand you have a podcast yourself. And
Yep. Breakaway Wealth Podcast, wealth building tips for the unconventional and rebellious. And then also our website, which is just simply CreateTailwind.com. And the reason being, most people are fighting a financial headwind. We show you how to create a tailwind.
Well, I can't thank you enough, Jim, for being on the show. It was great to chat with you, and I will make sure to include all of your links and everything in the show notes.
Awesome. Thank you very much. Thanks for having me.
Yeah, thank you. We've put a lot of effort into providing useful content, and if you found value in the show and have any interest in supporting us with a small donation, head over to patreon.com/housedudes.
And if you have any thoughts or questions, shoot us an email at info@housedudes.com. You can also find us on Facebook, Instagram, and Twitter @housedudes. And if you like what you're hearing, head over to iTunes, subscribe, rate, and review the podcast. It really helps other investors out there find the show.
And remember, massive positive impact requires
massive positive action. We'll see you next time. This episode was brought to you by housedudes.com. Do you have time to actively manage flipping and rentals yourself? If so, go for it. If you live in a market that won't cash flow or don't have the time to do all the work, are you just out of luck? If there was a way to participate more passively, would that appeal to you? I'm sure you have questions about how the process works and what to do next. If that's the case, fill out the form on housedudes.com/investors, and we'll reach out to see if you are a good fit for our business. This is first come, first serve, and we will have to stop taking applications when our goals are met. See you at housedudes.com/investors.
I don't like to tell a man what to do with his money, but if you ain't investing in property, then you're dumber than a dummy.
I'm not dumb. I'm smart.
Well, buy property. That's my advice.